Hi.
How's it going?
Pretty good. How are you?
Did you survive the windstorm?
Barely.
Yeah.
I was like hearing things falling on my house and power. I had no power for 24 hours.
I didn't either.
Yeah. Well, Mr. Solar. So how long? So it was cloudy. How long did your batteries last?
They made it. They made it the whole time.
The whole time.
Yeah. But my wife didn't know that the power was still out, so she was running the dryer.
Oh my gosh!
Like,
oopsies.
so one of them went down pretty good. We got a little close, but it was pretty fun. But I've been around for a long time here, right? And I've never seen it that windy ever.
Yeah, that was
my whole life.
Wild.
Yeah.
There's a bunch of trees in my backyard, branches from the
really?
neighbors' trees. Yeah.
I saw some videos of like trampolines that flew out of people's yards over the fence into the next yard. It was
I'm surprised
insane.
my umbrella made it. It was up. I had the patio umbrella up on accident.
You know those big chairs I have in the back by my pool, those big ones that swivel? They got blown into the pool. Yeah, I mean, it was amazing what was going on.
Oh
I've never seen anything like it. And the water from the pool was splashing on the fireplace.
No way.
I swear.
Oh my gosh.
It was, you have to see
It's been a wild
week.
It's been a
wild, yeah.
You know, one great thing to come out of this week is that the state has matched the federal tax filing and payment date extension. So now you have, my Californians, until October 15th to file and pay your taxes.
If you're in a disaster.
Yes, right. Which that list is getting pretty long here.
It's getting pretty bad. Yeah, right. But you don't have to. If you owe them money, you don't have to pay them by April 15th. Like you have another 6 months to get interest. Yeah. That's like if you have it in the right place, which we're going to talk about, you're going to get another 2%.
Yeah.
And that's like 2% less tax.
Yep.
In a way, right?
Yeah, this is
pretty
fantastic.
Pretty cool. Welcome to A Place of Possibility. We're happy to have you with us. I am Richard Del Monte.
And I'm Angela Wright.
Thank you for being here.
Yeah.
What are we talking about?
Today, well, the topic of the hour, obviously, we are talking about banks, bank failures, bank deposits. We have had so many questions from friends and from clients come our way. What is going on with the banks? Am I safe? So we're going to cover all of that today. We're going to talk about some of the high-profile bank failures, really the unexpected consequence of the Fed raising interest rates to tamp down inflation. It's caused quite a bit of concern, some panic per usual. You know, the media is riding high on this one. And, there are people who are concerned that this might be the beginning of the end for our economy, our banking system. It's Armageddon. And we'll talk about that as well and what we think.
Yeah. Great. And events have been moving so quickly that we're going to cover what's happened so far and help you understand what, if anything, you need to do to protect your hard-earned savings from letting you become a victim of the fallout of these bank failures. Just to recap what's been going on, in case if you've fallen in love lately and your head has been in the clouds, or if you've been in a coma and you didn't really know what was going on, we've had 3 regional banks fail last weekend. And there have been other shoes to fall in the ensuing days. And it's created a fair amount of volatility in the stock market. Not a ton, really, but a ton of volatility in the bond markets. It's been utter chaos there, especially the treasury markets.
Yeah. So let's talk specifics. The banks that failed last week were Silvergate, Silicon Valley Bank, and Signature Bank. You probably only recognize one of those names in your day-to-day banking because they were small and regional banks. So the biggest one, the one Silicon Valley Bank, let's talk about that first. It was founded in 1983 in Silicon Valley, and it catered to venture capitalists, startups, and the technology industry, which, as you know, those people make a lot of money. So they're putting their deposits there too, in addition to getting their financing from the bank. They built up a tremendous business. And in fact, in 2021, their deposits ballooned by 86%. Wow. That's amazing for a bank.
Sure.
And they've been riding high for decades.
Yeah. Until last week, that is. What happened was a series of shockingly inept and rookie mistakes by bank leadership, by the regulators. They should have some of the blame as well. And also, let's face it, by the depositors in the bank. They're to blame as well. And so, so
I feel like we might be seeing another Michael Lewis documentary coming out. Like, watch Netflix.
He's writing very quickly right now, for sure. So when banks take in deposits, they have to invest that money, those deposits, in assets that earn a higher return than the interest that they're paying the depositors, right? That's kind of common sense.
Mhm.
That's how banks make money. You know?
Yes.
Yeah.
And I have my friends like sending me these videos of these people who are acting like they've blown the lid on some massive banking conspiracy because they're telling people banks reinvest your money. Oh my goodness, what are we going to do? It's like, that is the literal business model of a bank. That's how they make money, by making money on your money. It's not inherently a bad thing. And it's like, what did you think banks do? Take your deposits, make these transactions, pay you interest like out of the kindness of their hearts? No, they have to make money. And this is one major way in which they do so.
For sure. So what banks have to do is they have to match, one of the things is they have to match the maturities of the investments they make with the money that they get from depositors to the anticipated withdrawals of the depositors themselves. And importantly, they have to be ready for any sudden out of the ordinary surges and withdrawals from their customers that will happen kind of without notice.
Yep.
Right? So this is where things get dicey, especially for Silicon Valley Bank's customers, because it was almost all in the tech industry. And it made the bank more susceptible to swings in the tech industry's fortunes. And let's face it, every industry has booms and busts, but the tech business, whoa, lollapaloozas, right? Yeah. So if you don't think so, think about the lead up that went into before the late 1990s, when everything that had an internet, URL after it, or .com, that was attached to a company was bid. They had startups. They made a fortune. Everybody became gazillionaires, followed by a bust when in 2000 to 2001, when boom, everything blew up and the .com whole fiasco happened, and the tech stocks went down by about 80% value that period of time. So they are booms and busts on steroids, and so the bank was really concentrated in that industry. When the Federal Reserve decided to slam the brakes on interest rates and start on low, cheap money and raise interest rates in early 2022, tech firms especially were really vulnerable to that, because a lot of them, the startups, for example, they need to borrow money. They need access to cheap money to be able to fund these startups. In the beginning periods, they burn a lot of money. They don't have any profit, so they're spending, building infrastructure, hiring great people, doing research and development, all that stuff, and it costs a fortune. Well, they ran out of startup money. It all just went dry. So they had to go to the bank, which everybody banked at Silicon Valley Bank, and they had to pull out money. Mm-hmm. And Silicon Valley Bank was like, "Oops, we weren't expecting this."
Yep.
So this caused Silicon Valley Bank to have to sell their reserves, their collateral, faster than they anticipated. And it turned out the bank had been investing, unbeknownst to most people, except I guess the bank, certainly not the regulators, they didn't seem to know, but they've been investing the money in longer term treasuries and mortgages, which normally is not bad. Those are guaranteed, 100% full faith and credit of the U.S. government on the treasury bill side and treasury bond side. But while they're really safe and they're going to get paid off, they are highly susceptible to interest rate swings.
Yeah, and we often say interest rates and bond prices move in opposite to each other, but not a lot of people understand what that means. So imagine, if you're watching live, we're going to put up a graphic of a teeter-totter, and if you're listening, you can find it in the show notes, or you can just imagine it, because I'm sure you've seen one. And so basically, when one child sits on one side and another sits on the other side, one goes down, one goes up. And if you're at the edges of the teeter-totter, you go up and down a lot more. Now imagine the children slide in to the center, to the fulcrum of the teeter-totter. Now they're only going to move a little bit, right?
If at all.
Right. Yeah. And this is a great analogy for how interest rates on bonds that mature at different times will move the prices of those bonds. Okay, so on one end of the teeter-totter is interest rates, and the other side is bond prices. Now, short-term bonds, those are treasury bills and notes that mature in a year or two, those would be located on the very center of the fulcrum. So when interest rates move, and they can move quite a bit, it still doesn't move the bond price that much. Everything kind of just, little tiny movements. It's like where you put your baby on the teeter-totter. If you were going to do that. Yeah. Okay, now coming out in duration, maturity, we use those words interchangeably, like a 30-year bond. The 30 years is the maturity or the duration. Now you're coming out to the edges of the teeter-totter. One tiny little move in interest rates and boop, off you go, right? So if interest rates are going up over here, bond prices are going to fall, and vice versa, right?
Yep. So what happened with the Silicon Valley Bank is when interest rates rose over the last 15 months, even though those investments were guaranteed to pay off, the current market value of the collateral went way down, and there was not enough money in collateral to back up the customers' deposits at the bank. And so when the customers started needing more money than the bank expected, they decided to go to the equity markets and borrow and sell more stock of the Silicon Valley Bank stock to the public, or some private investors. Actually, was what they tried to do it to through, and bring in about $2.5 billion to kind of plug the hole they had. Well, when that became public, because they had to issue that in a Form 8K filing with the SEC, people started panicking.
Surprise!
And the shareholders, and not the shareholders, but the depositors started thinking, they're underwater. They're not going to have enough money, and it set off a stampede of people trying to get the money out of the bank as fast as possible. And so they basically, there are only 37,000 customers at the bank. Then they have all these 150 billion plus of dollars. So you can imagine what the average account balance is, right? And so 93% of all the deposits at the bank were uninsured by FDIC insurance. So they were panicked. It was panic city. And they pulled out a whopping, well, you're going to talk about the amount they pulled out.
I will. Yeah, don't give it away.
But and so it wasn't insured, most of it.
Yeah, it was really unfortunate. And this is where lack of diversification is a perfect example of how it can bite you. Both as a depositor of a bank, there wasn't enough money there there wasn't enough FDIC insurance to cover the deposits, but also as an investor, if you held a lot of Silicon Valley Bank stock, that was a double whammy. I can't imagine someone that maybe had $1 million on deposit there and owned the stock. That would be painful. And so last Thursday, the customers withdrew an astounding $43 billion from the bank.
In a day.
This is pure panic, greed, mayhem.
Right.
And the FDIC took over the bank the next day. And by the end of the weekend, the government decided that the risk to the economy by letting this particular bank fail, and letting all the people in the tech industry lose this money, it was too great. So they stepped in and announced all of Silicon Valley Bank's deposits would be covered. And meanwhile, while this is happening, two more banks, Silvergate and Signature, were having the same kinds of troubles with their deposit collateral. Both of these banks, what's different about them is that they were very heavy into the cryptocurrency industry. Again, extremely volatile. It's been imploding. People want to get their money out. So similarly to Silicon Valley Bank, everybody ran for their money and the bank imploded. Silvergate, to their credit, their customers were always covered because they shut down operations and paid them out before we could get to the point of the FDIC having to take over. And Signatures will be backed by the Fed. So people are going to get their money out of these banks. It's really important, though, to just drive this point home. Even though the deposits at the bank were 100% covered, if you owned the bank's stock, there is no coverage for that.
Bye-bye.
Investing in a stock is inherently risky, and you lost a lot of money if you were one of those shareholders. And this is why we would never recommend a client put any more than 10% of their investments in any one security, bank, healthcare company, whatever.
Right.
Never more than 10% in one security.
Right. Meanwhile, back at the economy, fears have been expanding over the week that other regional banks and other players that are, may be susceptible to the same kinds of risks, and that banks in general were too risky. So the market started selling a lot of these stocks. The investors were panicking. They drove down almost every financial company down. Even Charles Schwab is driven way down, in value. And yesterday, the next shoe dropped where Credit Suisse, which is a Swiss bank, large bank, they needed to get a bailout from the Swiss government to the tune of $50 billion. They didn't really say what the reason was. I think it's the same kind of thing, though. It's maturity, the duration issues. And so Again, that set off another wave of panic, and people are very upset. And there's another bank that's locally here in San Francisco area called First Republic Bank, and they've been kind of going up and down a lot, in their share price. They keep assuring us that they've got plenty of money, but today some of the larger banks in the U.S. gave them $20 billion in deposits to keep them going. So that kind of ended the fears of First Republic. That's over. And the banks are going to get their money back when everything settles down. It's not like they gave them $20 billion. They just put money there instead of having it wherever else they put it. So we're not out of the woods yet, but there's probably a few more shoes to drop in the near term. Other banks, other situations that are coming to light. That said, this is not the 1930s, folks. And it's not even like the 2007, 2009 Great Recession, where bank balance sheets were filled with toxic debt, junk, garbage that was worth nothing, mortgages that were worth nothing, and derivatives. This is not then. Over the past 15 years since that Great Recession, banks have been required to change their holdings, their collateral, to really high quality investments, which means typically those are sovereign investments, sovereign debt and that means debt of the U.S. government and other major safe, mainstream governments in the world, France, Germany, etc. So, and the banks have been subjected by regulators to stress tests to assure that they can withstand whatever comes, risky, unstable times come in the future. However, this latest fiasco in the last week has uncovered the fact that, hey, regulators, you're going to have to start paying attention to the maturities of these bonds to assure that we never get in a situation like this again. And that's, we don't want to be here again. And they will do that. We'll
they will. Well, yeah.
We'll fix it.
I mean, in many ways, we were very much prepared for this.
Yeah.
Right? I mean, the only people who are really out their money are people invested in these banks. Unfortunately, the employees of some of these banks, the leaders. But, the systems and regulations were put in place. The ones put in place during the Depression were working. And now they just need to be improved, to prevent something like this from happening again.
Right. So many clients have been asking us, am I protected? I have money at XYZ bank, am I protected? So let's talk about how to make sure that you are protected in any bank accounts that you own.
Okay, so first, understand that you're protected by FDIC insurance up to $250,000 per person per bank. You should never keep more than this in any one bank. And I know it's a headache if you have $1 million you want to keep in cash to open an account at 5 different banks. It is, but it's worth it to get this protection.
Yeah.
Give us some examples of how this works. So people ask me, okay, well, I have a joint account and a trust. Like, how much coverage do I have?
Right. Okay. So individuals have $250,000 of coverage at the bank. Doesn't matter how many accounts they have. If it's a joint account, like a husband and wife, wife and wife, husband and husband, that would be $500,000, 250 times 2. Also, if you have a living trust account, and you have like 3 kids, or if you have what's called a transfer on death account or pay on death account, and you have beneficiaries attached to your account. If you have 3 beneficiaries, for example, and a husband and a married couple, you would have up to $1.5 million of FDIC insurance from that. So there's a calculator on the FDIC's website, and you can go in there and plug in all your information and find out exactly how much insurance you have on your accounts. Recommend that you do that if you're even at all concerned, or you can give us a call and we'll do that for you if you're a client.
Yeah. So people have also asked me, well, how do I know if an individual bank is safe for my deposits? The first and really only thing you need to look at is, are they FDIC insured or not? And the way you would know that, go to their website. It's at the very bottom of their website, and it will say FDIC member. And I'm going to tell you, if you've heard of the bank before, they're an FDIC member.
Sure.
There are I don't know that there are any even allowed to be a bank that's not. No. So you don't need to worry about that. And so with that, it doesn't really matter how solvent the bank is, because the FDIC will take care of you in an emergency situation. Most banks are also publicly traded entities, which means you can look at their financial statement. So if you really want to dig in and know if your bank is solvent, go take a look at that. If you're planning on buying a bank stock, you must take a look at those financial statements. But really, we're talking about putting your deposits at the bank right now.
Right. So are online banks as safe as the brick and mortar banks?
Good question.
The answer is yes, so long as you have FDIC insurance. We're going to keep pounding this away on this show.
Yeah.
Because it doesn't matter what bank you're in, don't get complacent and don't have more than the insured amount for any reason at all.
Yeah. Okay. So let's talk about some other alternatives for your money. Where do we put all of these bank deposits, and what are we going to do about it?
Right.
So first, as Richard was just saying, online banks are a great alternative to your brick and mortar, Wells Fargo, Bank of America, Chase. They pay much higher interest rates on your savings. I'm talking like 3.5% to 5% to your banks. What are they up to now? 0.5%?
If you're
maybe
lucky.
at Bank of America.
Yeah.
So this is, a win-win for you. You can open an account online right now, put in your bank information and transfer $250 per person into these online banks and start earning a better interest rate right away. And one of the reasons they can do this, somebody asked me like, well, that sounds shady. How come they can pay so much more? Are they a real business? Yeah, they're a real business. And the reason is they don't have all the overhead that the brick and mortar banks have. They don't have office rent for one thing. And, this is not an advertisement for ally.com, but I personally have my money there. And lots of our clients, we recommend it all the time. It is a safe place to put your money, so long as you're not going over the FDIC limits.
Right. And they always consistently have high rates, good
Much
rates.
higher. Yeah.
Yeah. They're not up and down. They don't bait and switch and try to get you in and then reduce the rate.
Yeah.
Some do.
Nice.
Okay. The next place to keep some safe money is broker money market funds. So we're talking about like the Schwabs of the world, Fidelities, Vanguard, Merrill Lynch, etc. They have money market funds that they actually manage themselves. What's inside those money market funds is typically things called commercial paper. These are like short-term loans to a bunch of different companies and stuff. Very well diversified. Nobody's ever lost a penny in those ever. There was one time during the Great Recession when one of those went from $1 a share down to 99 cents and everybody went crazy and the government stepped in and backstopped them. So, but nobody's, 50 years they've been around, they've been completely safe, but they don't have FDIC insurance because they're not bank products. So if that really bothers you, which it wouldn't bother me, but if you really are concerned, like we're going to go into Armageddon, then what you could do is buy a US Treasury only money fund at one of those brokers. And then everything that's in that fund is invested in Treasury securities. So typically T-bills. So and those are backed by the full faith and credit of the US government. So that is really safe and you shouldn't have any worries there at all.
Shouldn't, but I'll be honest. Some people have come to me saying, how can I trust the government is going to fulfill its duties, right? Is the government going to have the money for FDIC? Why would I buy a government bond if I'm already relying on the government? I do find this to be a very political, like people on one side of the political spectrum, especially have this belief that we cannot trust the financials of the US government. Let me just say this. If it comes to the point where the government cannot meet its obligations on its bonds or FDIC insurance, you have much bigger problems in your life. You don't care about your bank deposits anymore. You're scrambling for your guns, martial law, bunkers. Like something massively horrible is going on in our lives if this happens. And forget your bank balance.
Growing your own food, etc. Right?
Yeah. It's a big deal.
Yeah. So they'll I wouldn't sweat that. And it's the safest. Those are U.S. Treasury securities are the safest investments in the world. They're still perceived that way.
Yeah.
So another thing you could do for safe money, this is the last one we're going to cover, is actually go out and buy the T-bills yourself. Treasury bills are Treasury securities that are maturing in 1 year or less. You could buy them either directly from the government through treasurydirect.gov, or it's a lot simpler just to go to Schwab, Fidelity, Vanguard, and buy them from them. And you can buy any maturity one. You can get them maturing in a week from now if you want, all the way up to a year or longer. And again, they're backed by the full faith and credit of the U.S. government. Yep.
All right, let's switch gears and talk about stocks because everyone wants to know, how is this going to affect my investment portfolio? What's going to happen to the stock market? What if the financial sector goes down? How does that impact my portfolio? So let me just get my crystal ball out right there. I'm just kidding.
What does it say?
It says, I don't, Look, stocks have been really volatile this week. It's exactly what you would expect to see in a situation like this, but not as volatile as the bond market. Oof. It has been really wild. Yesterday, rates dropped by 0.5% on the 2-year treasury. That's a big, if we go back to that fulcrum, that's a big drop in a short-term,
unheard of.
A short-term bond. Yeah. I don't think I've ever seen that.
Yeah.
And today they bounced back substantially, which this indicates a lot of fear in the markets and uncertainty. That's what that tells us. And so what do we always say about fear and uncertainty? What do people do?
Well, first of all, we always try to optimize our clients' long-term outcomes by recommending against reacting to near-term concerns, right? Upsets like we're going through right now. This philosophy is based on our own principles and others' best thinking about how to improve your odds of investment success over a long period of time. As such, our strategy really expects that the unexpected will happen from time to time, like it happened this week. Mm-hmm. And to a point, to that point, when these dislocations that we've been having in the markets right now are actually the building blocks for higher returns in the future. They really are, because people panic and get out. Sorry, you just missed out on returns. People that stayed in or actually bought some more things when they were down are profiting from it. So we teach our clients consistently to expect the unexpected and roll with it. Don't get freaked out when these things happen, and definitely don't let it throw off your strategy. We use an analogy. We were talking about the weather the other day, with the wind and everything. When the windstorm hit, those of you in the Bay Area, well, what did you do when the windstorm hit?
I stayed inside my house.
Yeah. You didn't go out shopping and go?
No, I didn't. And, it's like when the massive windstorm is happening, just think about it like this. Is that the time to go out and prune your trees?
No. Definitely
Absolutely not. Stay inside.
You wait it out and wait for knowing that better weather is coming. I don't think anybody doubts that we're going to still have a summer and a beautiful spring, right. And it's the same thing with the investment markets. This temporary period of people being all upset and up in arms and predicting Armageddon is going to pass, just like every other time in the past.
I'm sure.
So just relax, stay in your house, pop on another Netflix and, enjoy yourself. Yeah, there's really nothing to do except wait it out.
Yeah,
honestly.
Great.
Yeah.
Okay, let's see what questions we have today. Okay. This is a good question. What if Schwab goes down? Really, really good question. So Schwab or any broker dealer, right? Fidelity, Vanguard, Merrill.
Yeah, good question.
They're the custodian of your investments, right? And if they become insolvent, there's something very similar to the FDIC. It's called SIPC. The S is for securities. And they protect you up to $500,000 per person per broker. So similarly to how the FDIC rules work, except it's $500,000 per. And so this is a situation in which not your stocks have gone down and lost value. That's investment risk, and it's always present. And there is no government entity to pick you up when that happens, which is why you diversify. But this is like Schwab goes bankrupt or something.
Or someone robs you and steals your money inside the bank.
Bad actor at Schwab, or some sort of malfeasance is going on.
Or a hacker.
Yeah. So not only do they have the government SIPC insurance, the large and good broker dealers have private insurance to cover them for things like hackers or employee DOA, whatever.
Right.
So you do have protection from your securities brokers as well.
Right. And that private insurance, at least in Schwab's case, goes up to $100 million per investor.
100 million.
Yeah. So you're okay. You're going to be fine.
Yeah.
Exactly. That's not a risk.
Oh,
okay. Well, we hope this has been helpful to you,
yes.
giving you a little bit more insight, maybe cause you to relax and
sunny out today
so
here in California. It's
beautiful,
a good day for a walk.
Yeah.
Thank you so much, as always, for being here. If you have a question or a topic suggestion, you can send it to info@aplaceofpossibility.com. If you'd like to schedule a consultation, maybe you want to review your accounts and how much FDIC insurance you have, you can click on the link in the show notes or on your screen to book an appointment. It goes right to our calendar. We're also continuing to offer the ebook, The Investment Answer. If you want to know more about what Richard was talking about, designing your portfolio to withstand these windstorms, it's in that book, and it's a really easy, accessible read to help you understand. If you're enjoying this, like and subscribe wherever you're listening. Thank you again so much for being here with us today.
Yep. And until next time, remember, you're invested and so are we. Take care.